Nedbank's board has approved a formal plan to dispose of its investment in Ecobank. The firm says it's engaging with interested parties on the matter. Commenting on the move, CEO Jason Quinn stated that the plan represents a reset of the lender's strategy on the rest of Africa as it looks to focus on Southern and East Africa through businesses that it owns and controls. Ecobank has a presence in more than 30 countries, mainly in Central and West Africa. The announcement comes alongside the release of the group's interim results. At the halfway stage, Nedbank has posted a 6% rise in headline earnings. That uptick was driven by non-interest revenue and associate income growth. A dividend of R10.28 has been declared, which is 5.8% higher than the previous period's payout. Looking ahead, Nedbank has noted that the 30% tariffs on South Africa's exports to the US, along with weaker global growth and sluggish commodity prices, are likely to undermine business confidence, hurt exports and discourage private sector and fixed investment. And so it's forecast a GDP growth of 1% this year. Given that this is expected to create a more difficult trading environment and with its planned disposal of Ecobank in mind, the bank has revised its 2025 guidance. It's now forecasting diluted HEPS growth for the year to be low single digits and return on equity to end the period around 15%. Strong, that's how the JSE has described its first half performance. The local bourse has reported a 13% climb in net profit after tax. It's attributed this in part to elevated equity market activity and noted that its diversified revenue base also helped. Going forward, the JSE says it is backed by a strong balance sheet, an expanding product and data offering, and a disciplined investment approach. And so the firm is well positioned to advance its strategic agenda in the second half. Telkom has got its new financial year off to a good start. During the first quarter, earnings before interest, tax, depreciation and amortization rose 6.5% as revenue edged up 1.1%. The mobile operator also highlighted a 9.6% increase in mobile data revenue and an 11.3% jump in revenue from fiber-based services. The company says this gives it confidence that it's headed in the right direction as it increases its focus on these two segments of the business. Shoprite is confident it will deliver profit growth for the full year. The retailer expects headline earnings per share to be between 15% and 25% higher. That growth largely due to a strong showing at its supermarkets RSA division. That unit has recorded sales growth of 9.5% during the year, which extends its unbroken market share gains to a fifth consecutive year. Shoprite will open its books on the 2nd of September. Pick n Pay has reported a 4.3% rise in group turnover for the 17 weeks to June the 29th. That's thanks to gains at its Boxer division. The retailer's core supermarket business remains in slow recovery. That unit posted flat turnover growth during the period, and like-for-like improvements were offset by store closures and conversions linked to its restructuring plan. Meanwhile, Boxer's total turnover grew 12%, boosted by new store openings and growing demand. Pick n Pay's trading statement also revealed that former Edcon and Massmart CEO Grant Patterson will join the group's board as an independent non-executive director designate. The company says Patterson is a highly respected business leader with extensive experience in the South African retail and consumer goods sector. And while he was at Massmart, he was instrumental in driving strategic growth, operational expansion and transformation. The private sector recorded a marginal improvement in July. The S&P Global SA Purchasing Managers Index rose to 50.3 points during the month. That's from 50.1 during the previous period. The uptick was supported by a rise in new business and steady output levels. And there will be relief at the pumps for some motorists tomorrow. Petrol prices will decrease by 28 cents a litre. That's as oil prices moderated and the rand appreciated on average against the US dollar. But those making use of diesel will feel the pinch as the cost of the fuel will rise by 63 cents a litre. Eliminating paraffin is also set to get more expensive as a litre will cost you 32 cents more. Further afield, BP will renew its portfolio of assets and consider more cost cuts as part of a drive to do better for shareholders, as it reported a second quarter profit that easily beat expectations. Here's more detail in this package report.
BP's second quarter profit easily beat expectations. The energy major also said it would take action to do better for its shareholders. Measures include reviewing its portfolio of assets and considering more cost cuts. CEO Murray Auchincloss has been under pressure to improve profitability. Earlier this year, he announced plans to sell $20 billion of assets through to 2027, as well as to cut spending, debts and costs. He signalled further action might follow, without giving details. BP already has a target to cut costs by $4 to $5 billion from 2023 levels. The oil giant posted Q2 underlying replacement cost profit, or adjusted net income, of $2.4 billion. That was down from $2.8 billion last year, but easily beat analyst forecasts. The quarterly performance benefited from a 33% increase in profit at BP's customers and products business. It was driven by strong oil trading results, higher volumes, and a 20% rise in earnings at its Castrol lubricants unit. BP shares were up in early trade.